I'm your host, Peter Resnicek from ShadowTrader.net, and this is the Weekend Edition. Today we're going to be speaking about the proverbial elephant in the room, which is that with market is at all-time highs consistently, and yet people seem to be hating on this rally. And the reason I think they are doing so is because the breadth is relatively narrow. We have a lot of leadership from big cap tech, but not so much leadership from other sectors. So we're going to get into that very specifically in this video. That and lots more, but before we do, let's get into the charts and find out what's really going on. If you recall in last week's program, we started by saying that when a market is at all-time highs, we have less reference from a technical perspective to deal with, right? We don't have a resistance point above us or technical reference where we can know where it will stop. So I was saying there's kind of less to talk about, and it's kind of where we find ourselves this week as the market's made new all-time highs once again. CPI print on Wednesday this past week was weaker than expected, indicating a little bit of a pullback in inflation. And then we had the Fed meeting on the same day. So markets gapped on that morning news and held really well on the Fed and then went a little bit higher. So let's take a look at the charts so we can see exactly what's going on. I'm going to start on this S&P daily here. If you recall from last week, we were talking about the channel here, or I should say wedge, that's kind of tightening. That's still happening, but notice that now all of the price action here has moved outside of it. And if you recall, we were also touching upon the fact that when you have a channel line that connects highs. Basically, if it connects highs across the top, I call it a channel. If it connects lows across the bottom, I call it a trend line. So just keep that in mind. So you've got this channel across the top, and I was saying that there's potential that it's resistant, and it was for a couple of days. And then you notice that in this week, especially on that news, we pulled higher, putting ourselves at new all-time highs once again. So we're outside of the channel. This wedge here still is tightening, but I would say you can forget about that for now since prices are now outside of it. Now, where does that leave us going forward for next week? There is a lot of market generated information happening right now in this market that tells me that we are not pausing here and we are probably going higher. First is the obvious, which is the fact that we gapped up and held. This is obviously called like a gap and hold, right? When you don't fill at all. And that's really, really important as well, especially when you're watching this closely on an intraday basis. And later in this program, I'm going to show you something from market internals that happened today on Friday the 14th that I think you'll find absolutely amazing. But before we get into that, just look at it in this perspective on the daily chart. You can clearly see the gap being unfilled. You see it here, and you see that Thursday and Friday is a double bottom. Remember that because we're going to touch upon it later. And you've got this unfilled gap. Keep it simple, as I always say. Keep your TA as simple as possible. And all technical analysis should deal with who's happy, who's sad, WWSHD. When what should happen doesn't. All gaps should fill. The market does not like gaps. When the gap doesn't fill, that's bullish. So as long as we remain above there, there's almost no chance for stronger sellers to come into this market unless they can get to like Thursdays and Fridays lows in the cash market. That would then threaten to potentially fill the gap. And then what's that going to do? That's going to put our 8 EMA into play, which should catch prices there. And then we know we've got this 21 rising up above. All right, so you've got plenty of technical support below as far as the unfilled gap, et cetera, but you know exactly where your eyeballs need to be next week on the Thursday and Friday low. It is a double bottom. We call that a weak low, obviously, because anytime you retest a reference, it weakens that reference. So we've got a weak low on Thursday, Friday, and we've got that 8 EMA coming up to touch. So basically, that's the situation there, all-time highs. Buyers remain in control, and again, you've got key technical areas to know when this starts to fail, and if it doesn't, just same MO, right? Market's going to be trying to get it higher. Real quick look on the NDX NASDAQ 100. I don't want to spend too much time on it because it is an almost identical chart to what we just saw in the S&P. The only thing I would mention is that the distance between the lows here and the 8 EMA is a little bit stretched. It's further out than the S&P. Obviously, this is where a lot of that big cap tech that we're going to be talking about resides, so it's pushing a little bit further. The only thing I would say is obviously the higher you get off that 8 on a daily basis, the more susceptible the market is to a liquidation break, so just keep that in mind. Last week I touched upon NVIDIA potentially having some weakness this week because it was going to be post the 10-to-1 split, and I thought there was a lot of speculative money going into the stock running into the split. That didn't happen. I mean, basically, as you know, if you check the NVIDIA chart, it was pushing towards that 130 level, holding there. We didn't see the pullback in NVIDIA. I would keep watching it as a bellwether, but as I was saying last week, now with it cut down in price by 1/10, it's probably not going to have as much of an influence on what goes on in the NASDAQ 100 and NQ futures as it did before, but always still something to watch. On to our lead story tonight. If you've been paying attention at all to the markets, you know that there's been a lot of divergence between big cap tech and the rest of the sectors. And I was saying in the intro to the show, this is why this rally feels a little bit hated, and it feels like people don't believe it, and they keep thinking that it's going to fall apart anytime soon. And it's because of this narrowness of the rally, that they're saying that it's not quite broad enough. So let's get a little bit deeper into that. I've put together this comparison chart here to share with you. And this is specifically a daily chart of the S&P 500, but I've overlaid two really important charts over it. The white line is an ETF called MGK, which is the ETF that represents basically big cap tech, basically. So you have Microsoft, NVIDIA, Google, Amazon, all these leading stocks are basically in this ETF. And the yellow line is the RSP on a daily as well, which is an ETF that represents an equal weighted S&P. So we know that the S&P itself, is weighted very heavily towards technology. It's about 30%. It's actually slightly over 30% right now of technology. And then the other sectors behind it, such as healthcare, financials, consumer discretionary, staples, et cetera, going all the way down through the 11 sectors, they are all weighted a little bit less. So if you look at this chart here, it clearly shows you that obviously the big cap tech is just way ahead of the market. And notice that the trajectory of the market itself more or less mirrors what's going on with the MGK. And at the same time, the RSP, which is the equal weighted S&P, which would be basically saying that what if utilities were worth just as much as tech or whatever, you can see how much lower it is and notice that it is actually not moving in the same trajectory as the market. For instance, this rally here, what happened with the RSP was relatively flat, right? So this is basically the reason in a graphical representation of why people are worried about this market, because the general mode of thinking is that a narrow rally is not sustainable, but I'm not so sure about that for a couple of reasons. The first reason, I can't really point to anything specific chart-wise, but I'll share it with you anyway, is that I believe that markets may have changed. These rules that used to be hard and fast long time ago, I'm talking 60s, 70s, into the 80s, etc. This may not be true. We may have a completely changed market, and this big cap tech could actually lead us much, much longer. The other thing I'm thinking is that in order for the market to fall down hard, these sectors here that are represented more equal weight, all the sectors in the S&P that are not technology, I believe they have to be more bearish than they are currently in order to be signaling that the market actually is in a downturn. So that being said, let's go over to the charts and let's look at some of the other sectors that are not technology to see how they're faring, okay? I'm going to start with this one here, which is healthcare. I start with it specifically because it is the second highest weighted sector in the whole S&P. And I'm going to go through these purposely on weekly charts rather than daily charts so that we can see, just, kind of gives us a more longer term time frame to see what the bias is on the chart. So to me here, there's absolutely nothing bearish going on here other than that you have this wedge tightening, which again could be up, could be down, we don't know. But really, if you look at it where it is in relation to all-time highs, we're not that far off it. And there's really nothing on this particular pattern that you could point to that is bullish. And I think that's important, right? If we're thinking of a market that's going to fall down anytime soon, again, we should probably be seeing at least some bearish patterns in some of these sectors that are pushing at lows, ready to break down, that would pull the market down hard the moment that that tech rally reverses. So again, as far as healthcare is concerned, I'm not really seeing it. This is a very bullish to neutral chart, if anything, leaning more bullish than neutral. Let's move on to the financial sector. This one in particular, XLF, this is 12.9% of the S&P. Little bit of a rollover, and you could make the argument that you're starting to see somewhat of a maybe head and shoulders pattern here. So I would keep an eye on this one because it does look like it's rolling over a little bit. Powell this week basically said, look, I'm ready and I'll do whatever needs to be done, basically. That was the takeaway I thought from the press conference in terms of Jay Powell speaking on Wednesday. And maybe the financials are seeing the rate cuts coming. They tend to perform better in a higher rate environment, at least the banks, et cetera. So we'll see. You know, it's hard to say. There's a lot of different things pushing on it. We don't know exactly what is causing the downturn, but that could be. But again, is there anything really bearish here? You can't really point to it. If you look at this weekly chart, you know, you haven't taken out this prior support at all. You're holding on the 8 EMA on the weekly, just kind of sitting there, and you're really just within a range, basically. So again, there's nothing bearish on this chart either as far as financials are concerned, and they're about 13% of the S&P. Let's move on to consumer discretionary. This is an important one, right? We know that the consumer makes up most of the economy, and that's reflected in these stocks. And again, can you actually point to anything in this weekly chart that is bearish? I would have to say no, right? You've got it kind of tightening to a point here, but look at where the midpoint is of this range. You're basically there. You really haven't moved much. So this is really endemic of what we talked about in the first chart there when I showed you how the equal weight sectors don't have the same trajectory as the S&P itself, as big cap tech, but a lot of them are just not moving, and that's why. It's like the market is advancing, these sectors are not advancing with it, but at the same time they are not falling, and they're also not setting up any bearish patterns, which would lead me to believe that the market is susceptible to a larger downturn. On to industrials, and as we move down lower in the 11 sectors, they have less and less weight in the S&P. This one right now is 8.5% of the S&P. These weights, by the way, in case you don't know, they change monthly, and that's at spglobal.com. That's where you can get these weights right here. But industrials, 8.5% of the market. Again, is it moving with the market? No. These are weekly charts, so you can see clearly that the last 4 to 5 weeks have been down while the market has been up. And again, this is why that equal weight RSP is weak, while the regularly weighted or properly weighted S&P is so much more bullish. But again, is there anything bearish here that would tell us that we're going to absolutely fall apart? I think no. Notice that even when the industrials tried to get below this particular low here, they actually failed it, right? You actually have sort of a shadow there, and we were not even able to get back down through that low. So I keep industrials in the same camp as everybody else in terms of not really participating with the rally as much, but also no real bearish setup. Onto the communication sector as defined by the ETF XLC. Again, this one's actually moving with the market, maybe not as strong as big cap tech, but you can see all of these last bars here on the weekly have been up, culminating in a doji this week where it just kind of went sideways. But look at the 8 EMA, look at the 21 here, look at the stacking. It's just riding along just nice. So this particular sector, it has not only nothing bearish in it, but I would say it's quite bullish, and these communication stocks are probably being bought on pullbacks. On to consumer staples, XLP, yet again, straight sideways. As a matter of fact, on this weekly chart, if you look on the longer term perspective, where are we in relation to prior highs, prior lows? You're actually closer to where you had some highs there historically. And again, it's just sort of rolling along, but there's just nothing really bearish here. This is the last few weeks in question. And again, I keep going back to it. Yes, the market is advancing. These sectors are not. Many of them are just in a holding pattern, but they're also not setting up any bearish plays at the moment. Now we're getting into what I like to call the final four, because they're the bottom of the S&P sectors. They are the 4 sectors of the 11 that have the least weight on the market. Those, of course, being energy, utilities, materials, and real estate. So let's start out with this energy here. The one thing I want to say about this is a big caveat about these last 4, is that these are the sectors that are going to move independently of the market very, very often. We know that, right? Think of how energy moves. Think of how real estate stocks move, because they're a little bit more sensitive to rates, etc. Materials has gold, copper, things like that. These sectors will move independently of the market more than others, but altogether they only make up about 10 or 11% of the S&P, even when all 4 are added together in the aggregate. So oil stocks definitely are looking like they are a bit weaker than the market. You can see the last few weeks here, actually quite a while, it's been more like 10 weeks have been down while the market has been rallying. So, you know, could you say, yes, this is more of a bearish setup? Probably. I mean, you're going to probably be looking to be shorting the trend line as you go up. As long as that downtrend line stays, I think people are going to be shorting there. Obviously, you have to be looking at the price of crude a lot. That has a lot to do with it. But certainly this sector does look a little bit more bearish. But as I was saying, these are the ones that will often go opposite the market, regardless of what the market is doing. We could be in a bullish market, we could be in a bearish market, and we'll see divergence in these last 4 sectors. So I wouldn't put too much weight on them. Let's go into utilities real quick. As I was saying, this is a bullish chart to me. I think this is the most bondish, not really a word, but you can think of what that means. It's the most bondish, so to speak, of the sectors in that it acts most like the bond market. I'm very bullish on TLT right now, as I've been saying on X and in my room, etc. People know that I'm kind of a current bond bull. I'm not a bond bull in the bigger picture, but I am bullish on bonds right now. I think XLU will recover. This is a very, very small part of the market. Again, just keep in mind it can move independently, but these pullbacks are probably buyable. And for what it's worth, even though it's only about 2.5% of the S&P, this probably would be pulling the market in the upward direction rather than the downward direction if the sector finds some footing soon, which I believe it will. Rounding it out, second to last one, materials, 2.3% of the S&P. I'd say a little bit more bearish on this one, but again, focus on the fact that it's 2.3% of the S&P. Downtrend is in place, even with the rest of the market in an uptrend. On the weekly chart, it is catching support here at the 8 EMA, and as you can see, we are still well above the prior low. That's important. I think in this whole exercise that we're going through these sectors, one of the takeaways that you should have is the fact that we've had some lows prior to here, and even though these sectors have not been participating in the rallies, have any of them taken out those prior last lows just to the left? None of them really have. So that's basically the same situation with materials, and they could easily turn back to the upside. And our last sector in our 11 is real estate, only 2.2% of the S&P. I think this one is bullish, similar to utilities. Basically, lower rates are coming. We know that. It might take a little bit longer than we thought, but lower rates are coming. And this sector, I think, knows it because it's not anywhere near lows where it was here. Nice rally, and since then we've just sort of been balancing. This week was relatively bullish. I think it kind of holds its own because nobody's going to be selling REITs and other real estate related holdings knowing that rate cuts are coming pretty soon, if a little bit at the end of this year and definitely some more probably in 2025. So that's basically my take on the whole market being narrow and the breadth being narrow. My main takeaway here is that if this is going to lead to a market downturn soon, I think that we would be seeing the other sectors besides technology, everything that's behind XLK in the hierarchy, I think we would see them with more bearish patterns than we're seeing here, and I'm just not seeing it. Beyond that, touch upon a little bit of what I said when I started this segment, is the simple fact that things may have changed, right? That's something that I can't specifically prove by looking at any charts or anything absolute or specific, but this is how markets work, right? Think about the concept of Dow theory, right? Dow theory is something probably 100 years old at this point, maybe more. If you read up on it, it's pretty much dead, right? That was the theory that, the market's going to follow transports and utilities are very important and industrials are important, and it was all about transports and utilities making certain moves, and if those moves confirmed, then you'd see the same move in industrials. But at that time, industrials was the market. We were not living in an information society where all of the S&P is so heavily weighted towards technology, right? It was a completely different world. So things changed. That's just one example of how certain modes of thinking that were very, very prevalent at one time, they worked then, but they don't really work anymore. And so keep that kind of in mind as you navigate this rally and you read all the stuff about the market and you see all these people on TV constantly telling you that this rally is narrow, this rally is narrow. They're right, but that doesn't necessarily mean that it can't go on for much, much longer, even from here, all right? Keep that in mind. We just did a good amount of analysis together from a broader perspective, talking about the S&P itself, equal weight versus mega cap. We drilled down into the sectors, and now I want to drill down a little bit more and get a little bit more granular, kind of like one step lower, and talk a little bit about market internals. What I'm about to show you, I think, is going to be of immense help to you in your own trading. So as you know, I am all about market internals, meaning what is the context of the move that's happening in the markets. I'm always always top down, meaning that I start with the broad market and every single one of my trades is always going in the direction of the broad market. If the market is moving up, I'm selling puts and buying calls. If I feel the market is moving down, I'm doing the opposite. Then beyond that, on a day time frame basis, intraday, I'm watching for a lot of contextual clues to tell me what exactly the market is going to be doing that particular day so that I can hone those entries and get better location, all right? That being said, let's take a look at this snapshot that I put together for you today from Friday, June 14th. I took a picture of it at the end of the day because I thought it'd be easier to share than actually looking at it on a chart. But basically, this is what I call the sidebar. And I call it the sidebar because on my particular trading setup in my rig, if you can imagine, I've got a 49-inch monitor here in the middle, and I've got two monitors on the side, both of which are turned portrait instead of landscape. So I call those the sidebars. And I've got the market internals, this screen here on the left side, and the market profile on the right side. So this particular sidebar basically is the new quad, so to speak. Those of you who have been with me for a long time, you know that the market internals used to be the quad setup, and we called it that because it was 4 charts. It was that matrix of the breadth, the advanced decline line, the tick over here in the lower left corner, and then the market itself in the lower right corner being usually the ES or the S&P 500. So I've moved on from that and I've changed a bit because markets change, things change, right? Just like we talked about Dow theory, etc. Things work for a while and then they become obsolete. Your job as a trader is to constantly change with the market. So in that sense, I'm now using these 3 charts instead of those 4. And just to break it down for you, the top is the S&P 500 on a 30-minute time frame. The middle chart is the weighted AD, which is the pictorial representation of the 11 sectors of the S&P, weighted according to their each individual weight. So technology first, financial second, healthcare third, etc. And creating a histogram showing you what the percentage change is in aggregate from the open, so either going up or down. And the bottom one is one that we call the iceberg tick, and we call it the iceberg tick because you notice that there's this water line in the middle which is 0, and then it's either printing green for the time that is spent above 0, and this is the New York Stock Exchange tick. You can chart any tick you like using this. It could be the S&P 500 tick, it could be a NASDAQ 100 tick, whatever you like. And any area under the water line is painted in red paint. I have purposely circled this area here to show you because it is the area from this morning, June 14th, around 10:30 to 10:40 a.m. And I want to show you something very, very interesting. And if you were trading today, you're going to know exactly what I was talking about. Notice that at that exact time, the market actually double bottomed with a prior low from the prior session. We actually were in a bearish tape moving down towards the prior day's low, and we actually came very, very close to it. In the futures market, it was an exact double bottom. It was perfect to the tick. In the cash market, you can see it's not so perfect, but it doesn't matter, basically right to it. What I want to point out to you is that these are the exact situations. You can see the market turned up sharply from there and then closed all the way up here towards the end of the day. These are the exact situations where traders who do not understand context and do not have these tools on their desktop, this is where they get in trouble because they are looking to short those lows thinking that there's going to be a breakdown. And if you don't have contextual clues and you only look at the market itself in terms of price and daily charts, I couldn't fault you for doing that, right? The market is slightly overbought. It is way up there. It probably needs to come down a little. Some more consolidation would be helpful, right? We know that we were trading on a gap a couple of days ago from that CPI print, and what was the market doing? Looking to fill that gap. So here we're retesting it, but that gap fill failed a couple of times, and that's also important market generated information, obviously, to carry forward, telling us that the market is strong. As we were coming down to that low, what I want to point out to you specifically is these 2 charts here in what they were doing, especially the iceberg tick, which I'll save for last. Your weighted AD indicator only was making right here at this yellow histogram a very incremental lower low than where the lowest point was prior to that, around 10 a.m., about a half hour prior to that, right? So not really a big lower low. And then notice that as soon as that was hit, immediate improvement, and that's really, really important because this is exactly what the driver of the market actually is. When that histogram goes from yellow to purple and starts to immediately improve in a big way, as we saw it, that tells you that those 11 sectors are basically turning up, right? Remember, this is measuring their percentage gain or loss from the open, so they're immediately turning up. If they're turning up, the ES is not going lower. It's just how it is, right? The ES is nothing more than following the S&P cash, right? It is the tail and the S&P is the dog. That's really how it is. In an overnight session, it's the other way around because there is no dog, right? There's really only the tail. There's only the overnight activity, and it's just the supply and demand of the overnight activity. But during the day, this is in lockstep with the S&P. So you have this improvement immediately. That is a signal right away that you should no longer be short and you are not going to get the breakdown. But here's the real star of the show as far as today is concerned, and that's the iceberg tick. Look at the little line I drew here. That line is from the open on Friday morning, and look right here in the middle here of this area. Look what's happening. As the market is coming down, is the nicey tick making lower lows to confirm it? No, it's actually making higher lows. It's starting here, higher low, and right here was the next higher low, and that's happening right in here, right when we were bottoming out. And in my room today in the weekly options advisory, I specifically called this out live. The moment it was happening, as soon as we were touching down to that prior low, first thing I said is I immediately go to context and I said, hey, heads up, everybody, nicey tick making higher lows, nicey tick making higher lows. And lo and behold, look what happened after that. Tick actually went positive. This improved all the way to the zero line where you went from a low reading all the way to parity. And as far as price is concerned, you know, it's just, you can see it obviously. And when we closed near the high of the session, that was actually the low of the session. So these tools are really, really important. I can't stress enough how valuable they can be for you, even if you're not a day time frame trader, right? Think about it if this helped you to hold on to a long longer, or maybe sell some puts for credit that you weren't sure if you wanted to hold off on selling and you were able to sell them at the low. There's a million different ways or applications to this in all different time frames, not just day trading, but of course it's super powerful for day trading futures, right? Weighted AD and iceberg tick available at our website. These are proprietary to us. We basically invented these. Nobody else has this. We've got it available for a few different platforms. Check the links in the description below if you're interested in getting these on your platform. And I highly recommend it because I think if you have this whole setup here, watching that context closely, give it a couple of weeks, get acclimated with it, I think it's going to completely change your trading life for the better. Time now for that portion of the program where I leave you with a solid trade idea for next week or moving forward from there. And this week it is Meta is our trade idea this week, aka Facebook. Now they call it Meta, but let's take a look at the daily chart. This is where I think things get really interesting, and it is setting up for a nice move higher potentially as early as next week. So daily chart of Meta, I think there's a lot going on here to unpack. First thing I want to talk about is the fact that we are coming off of an area here of large congestion. And whenever you see congestion on a chart like that, I want you to think of the word pressure, okay? It's a buildup of pressure. Prices are in balance, but they can't stay in balance forever. And eventually they have to have what we call price exploration in one direction or the next. And when they have price exploration, what they do is they move in a clean manner or straight line until they find a new price where they can balance again, right? This market here is extremely efficient in terms of the shares of Meta because it is distributing a lot of shares to the greatest number of people, all at the same price, and that price is deemed fair. Then, as I was saying, it breaks out, it finds a new fair price. That's the situation that we find ourselves in right now with Meta, is that we are exploring higher and moving to a potentially higher price. As far as the chart is concerned, in terms of the setup, pretty obvious, right? In terms of you have a nice clean move up and then you're pulling back and you're coming to where? You're coming basically right to the 8 EMA. And notice that the pullback today on Friday the 14th didn't even make it there. So basically looking bullish. And I think the stock wants to hook up this way and at the very least maybe see these highs here at 530 over the next couple of weeks. So my play right now is what I call a risk reversal. This is the play that I have already done in my weekly options advisor. We've actually done two things this week. One was that for this week's expiry, we already sold the 490 puts rather. We sold some 490 puts. Why did we do that? Because they were here underneath the 8 EMA and we knew we could do them for very, very short duration. We did that at about a DTE2 earlier this week. We sold some 490 puts. Those went to zero. We already collected that credit. We kept it. And now in the next week, we are now short the 480 puts. We actually went a little bit lower because we've got a little bit more time and we are short the puts at 480. Why does that make sense? Because obviously it's below the 8, below the uptrend, if you want to put a little uptrend, and down, as I said, below the 8 EMA. So those puts should be safe. We were getting about $1.22 earlier in today's session, and towards the end of the session, we added a couple more, and we received about $1 for them. So I like that put credit. But here's where the trade really makes a lot more money if we get the expected move to the upside, and that's the fact that we have also put on a ratio spread to the upside targeting that 530 area. So the structure that I have on right now is very simply -3 up here at 530 and +1 at 505. So if this stock is to turn up, basically selling 3 times the 530s is just taking away some of the cost of the 505s. As you can imagine, those 505s are quite expensive, but we got them at a big discount. So altogether, that package cost us about $4.50 per share. It would have been a lot more had we not sold those 3. So anyway, as the stock moves up, what makes this play very attractive is not only do we have the put credit working for us that is also easing the cost of that 450 by a lot more, in addition to the fact that the structure is easing its cost as it is, but more importantly, notice where we started our long strike. We are long the 505 put. Those shorts up there at 530 and the shorts down here at 480, all they are really doing together is paying for the 505 put, or 505 call, excuse me, so that we don't have to pay for it. And again, the kicker is that it's relatively close to price. Notice where we closed here, 504.16. We are almost at the money, basically, on that particular call. So even just the slightest move up next week in Facebook, let's say that Facebook by the end of next week finishes at, let's say, 511. Right? Let's just pick a number, 511, like it doesn't get anywhere near the 530 target. Well, the 505 is going to be worth $6. I told you that we paid $450, but we paid a lot less than $450 because we paid $450 minus the credits that we sold this week, right? We already had some money in the bank on the DTE2 trade of the June 14th expiry, and we've got the money in the bank from the 480 put. So our cost is going to be closer to $1.50 or $2 a contract, whatever, and if that sells for $6, that's a pretty solid trade, all right? So as long as this doesn't take off too much on Monday morning, it's probably something you can still get into. A lot of different ways you can structure it. This is my MO. This is how I generally operate in my advisory at in the weekly options, where I like to set up the structure in such a way that I'm paying the least amount of debit that I can. Thus, if the stock goes sideways or a little bit down, I'm not going to lose any money, and that trade just kind of goes into a break-even column rather than a loser, all right? Remember, as always, if you want to trade with me, check the link down in the description below, and I'd love to see you in the room. And that's our show for this week. Thanks for hanging out. As always, hit the like and subscribe buttons if you can. That really helps out the channel a lot. And there are links in the description below where you can check out all of our trading rooms for $7 for a 1-week trial. Live Trading Suite, which is our 2 rooms for the price of 1 package. Don't forget, that one you can get for 6 months free. We've got a partnership going on with our friends at Tasty Trade. If you open an account with them, you can get 6 months free of the Live Trading Suite. So take advantage of that in the links in the description below, all right? Market action is bullish and it remains bullish. If I could leave you with anything for next week, it would be this, simply that pay attention to that gap that happened on Wednesday morning on that CPI print. Thus far, the market has had much difficulty filling more of that gap than even just a little. There's still a nice fat gap there on the charts. The longer that stays unfilled, basically the more bullish this market is. And in the bigger picture, we talked a lot about the divergence between technology stocks and the other 10 sectors. That's why I purposely wanted to go through weekly charts with you of all of the other 10 sectors to show you that there's really nothing overtly bearish in any of those other 10 sectors. And my take is that this rally could easily continue much further on than from this point where it is here. It could keep going on much longer as long as we don't see any really bearish action in those other 10 sectors. All right, that's all for this week. Next week is a shortened week. It's Juneteenth, excuse me, on Wednesday, so it's a market holiday. The market will be closed. Shortened week. That's always fun for weekly options traders. Coming at you from Los Angeles, California. As always, I wish you good trading and good night.